which is where we're going to go next here, Greg. We're going to move into our last segment here for today's show, into a fundamental analysis segment. And Coach Greg, you're called Old Money Homes for a reason. You have a mindset about the way that you approach markets and investments, which is old school, and it's very, very welcome addition. Instead of all the crazy new stuff that's always flying through the marketplaces, you keep anchored and centered in your personal approach to the market around dividends, fundamentals, value investing, reasonable expectations. And I think it's an awesome thing. So we're going to play a little round of buy one, hold one, and dump one, where Coach Greg finds 3 companies within a theme, and he presents those companies as fundamental ideas. And then we all get to judge which one we like, which one we would buy, which one we'd hold, which one we'd dump. Greg, you're up, man. What you got?
All right. So since industrials has been real strong recently, I thought we'd go into that space this week. I found 3 candidates. They all kind of little bit different, a little bit the same. They've got some nuances to them. We're going to look at not only the fundamental and the dividend part of it, but we're also going to we're going to run through the chart itself. So first up, we had ADP. So automatic data processing. If you guys if you don't know who this company is, they've been around forever and a day. Real solid, fundamentally speaking, just a good quality company. Like I said, I've been watching these guys for the better part of 15 years. I've always liked ADP. They're in the industrial space. They kind of get put in there. Like I said, everything's just been real strong. Now, what you're going to notice is these stocks are a little bit more expensive, so you'll probably end up with less shares if you're doing an investment or position trade. But the reality is these companies, they bring with them a fundamental stability that I like. So looking at this one here, this is a weekly chart. If you go to, so we just had a little breakout there. Might be a little fake out there. I still like the break above 200 on this one. I think this is still got some room to go. A little high base pattern, ascending triangle that we've had just there. So technically speaking, I like it. I still think it's got some room to run. If you're looking to get in, it'd be above that high price there, obviously. So each one of these, like I said, has a fundamental, but it also has a growth component, which we'll also talk about. So just the numbers for ADP here, 198 bucks a share at 196, I guess, right now. Their dividend yields about 1.87%. They've had 45 years of consecutive dividend increases. Their dividends they started paying in 1974, so essentially every year since they've been around, they've increased their dividend almost. And then their payout ratio is only 64%, so they can continue their payouts without too much of a problem. Their PE ratio is sitting around 34. Now their sales growth or their revenue right now, it's about 2.4% this year growth. And next year, they're expecting 6.2% growth. So they're expecting an upswing in the following year, probably due to reopening theme or something to that effect. Not really sure why, but I like the fact that they're even looking at bigger growth next year than they've got this year.
Mm-hmm. Okay. So ADP is your first one, obviously in staffing and employment services in the industrial sector. Wonderful long-term trends here that have been intact, and a clean $200 breakout if you're looking for a trade idea. But the dividend and the PE ratio at 34, they've got some interesting sales numbers as well, Greg. Okay, what you got second?
Eaton, ETN. So all of these kind of technically speaking, this one's actually gotten a little even more aggressive recently, as you can see by the slope of it. But overall, nice long-term chart. Got some solid history on this one as well. We're looking at a breakout, $150 breakout. So, our first two, we're looking at a $200 breakout here. We're looking at a $150 breakout. So there is a technical play involved for these as well. Like I said, this corporation been around a while as well. Their numbers kind of stack up like this. They're over a 2% dividend at 2.08. They've got 7 years of consecutive dividend increases. Their dividends, they started paying in 1923. So they've been paying dividends a long time. 84% payout ratio. They've got a PE of 41. Their current sales growth numbers are about 6.4%. And sales growth next year, they're expecting about 3.9%. So a little different than the first one we looked at, but chart wise, I really like them, and history wise, they've paid dividends, for a long, long time. They've got 7 years of consecutive dividend increases. So fundamentally, I like them that way. And as I said, they're kind of setting up for a pattern here as well.
They consistently buy back their shares as well, as what I'm looking at here on my end. A couple of different notes. Obviously drawing shares from the market can continue to drive prices. That's one way that companies can reward investors and all that kind of stuff. Okay, gotcha. So Eaton second, specialty industrial machinery type of company, a little bit different industry within industrials, but obviously both beautiful, beautiful charts. 2% dividend, 41 PE. What you got third?
All right, third is Illinois Tool Works. So this one here has been on my radar for a very long time. It's a higher dollar stock, but it's, if you look at it, kind of, I don't know how many years that is that you got, Tyler, there, but it was a 10-year chart. Yeah, so 10-year weekly. You can see that this thing's a juggernaut. Even when it comes down, it finds a base and then takes off again, which is what I like to see from dividend payers. So we're at a point now, if we go back to the daily chart, you're forming a little resistance right there where we are now. Looking for that breakout above the 235 level there. So from a technical standpoint, you get a run up to 242 pretty easily. So I like that. Numbers wise, we're going to be very similar to Eaton, but 1.95% dividend yield. Again, 7 years of consecutive dividend increases. These guys have been around since 1933. That's when they first started paying dividends. Their payout ratio is at a healthy 64%. They are also at a 34 PE ratio. Now, their sales growth on these ones, 14.1% this year, and an expected sales growth of 5.4% next year. So some really solid numbers, both from this company as well. And like I said, this one's been on my radar for a long, long time. And I think there's some good fundamental stuff here from all three of these companies.
All right, and I'm glad, Tyler, you kind of composed this with Greg pre-show so that we could visually kind of see some of the data. I thought that was really, really smart, and I appreciate you guys doing that. By the way, it's going to make it easier because this one's a tough one for me here. The game, Cody, is simple. You got to buy one of these, you got to hold one of these, and you got to dump one of these. So it forces your hand to make a decision somewhat. ADP, Tyler, restate some of the data as you're seeing here on the screen. Let's think through it, and then I'll decide who I want to go first based on whether I've made a decision or not. So let's go.
But yeah, part of the reason this is a trickier episode is because these numbers are very similar. And so anyway, so for ADP, $198.44, dividend yield 1.87%. It's increased its dividend for 45 consecutive years. So that speaks to the stability and the consistency of them running the business. Started paying in 1974. They pay out 64% of their. This would be not revenue, but earnings, correct?
Yeah, earnings.
Okay. So for every $100 in earnings they make, 64% of that is going towards paying shareholders via dividends. Trading at 34 times earnings, which means if they made $1 in earnings, their stock price is trading for $34. That's the ratio. Growing 2.4% this year, projected next year at 6.2. And you got Eaton trading around $145, 2.0% dividend yield. So that one's the highest. And you know what I want to do is I want to bold the ones that are highest in each column here. Increased the dividends 7 years in a row, started paying dividends in 1923. They pay 84% of their earnings out in dividends. PE ratio is 41. Growth rate this year, 6.4, next year, 3.9. Finally, Illinois Tool Works, yes.
Yep.
233, stock price, 1.95% dividend yield, 7 years of increasing dividends consecutively. Started paying dividends in 1933, 64% payout ratio. These two guys are matching each other, aren't they? 14.1% sales growth this year, 5.4 next year.
Yeah, they match, but they're both both in the same sector, but they're both different type of companies, which I find to be interesting.
Sure.
Coincidence there for you.
Sure. All right. I think I'm leaning where I want to go. Anybody want to go first? I'll go first.
You can
Go back on the
first.
chart here for a second here, Tyler. Three very interesting companies in that regard, and I appreciate you breaking all the numbers down. I know dividend payout ratios and also the number of years is very, very significant to you, Greg. It's something that you cite and you bring up quite often, so I will respect that data in that regard. But here's the thing: I don't necessarily need the 100-year dividend increases for me to want to buy a company, right? If I believe in the fundamentals, I like the valuation. I like their sales projections, and they've been increasing dividends for 7-8 years. I'm comfortable there, and personally, because I like a blend of value and growth, I don't necessarily need the highest payout ratio of every bit of their earnings. Because Tyler, if they're using all of their earnings to pay dividends, what are they doing to reinvest in the company, right? Are they just
Right.
maintaining operations, all that kind of stuff? I like ADP as the buy. Okay. Give me ADP first, and I'll tell you why I like it, Greg. And it might be my leaning and my bias towards some growth in there. Their sales numbers have been growing year over year. 11 billion in sales in 2016, 12 billion in 17, 13 billion in 18, 14 billion in 19, nearly 15 billion in 20, even on the pandemic. Guys, that's consistently growing your underlying sales numbers, which helps fuel your company. I like that. They have a consistent buyback program. Tyler, probably some of the money, instead of issuing into dividends, they're using in buybacks as well on ADP. And I'm looking at a 64% payout ratio on ADP instead of the 84% against ETN. I'm okay with that because they do still pay the 1.9% dividend, right? Sales growth this year was not great, which you cited, when I went to 11, 12, 13, 14, almost 15. I said almost 15 for a reason. They did slow down in 2020, but their future sales projections are to get right back in line, with where they've been over the last 7 years. I like that. Their trend is intact. Their revenue increases are intact, and their earnings per share increases, by the way, they are cashing in on the sales growth. They've increased that year over year, including last year during the pandemic. 34 PE ratio is not going to make you feel all saucy if you're a value investor looking for a 10 PE ratio. I get it, Greg. I get it. But that's not the market we live in 2021 when we're pushing all-time highs on the back of all the money that's been flooding out there, pushing equity prices higher. I like ADP as the buy. Okay. That I know, number one. Going to the other two is going to be a little bit more difficult. I think what I would probably do is hold Eaton as the hold. It does pay out a lot of its money in its payout ratio. That's a nice holding company, right? If you know their business model is sound, and it is, I'm looking at them compared to their competitors, 40 PE ratio, a lot higher, right? 41, I get that. But their forward PE ratio is lower than both of the other two. Their forward PE ratio is 21. Their PEG ratio is a little bit lower. They're projecting nice growth over the next 5 years. Next year's sales growth, Greg, yes, is lower, but their 5-year projection is higher than the other two. So with a 2.1% dividend, 84% payout ratio, and the potential for longer term stability in the company, I'm holding Eaton and I'm dumping ITW just because that's the game. And I got to dump one of them. It's a fine company too. I got no problem with it, but that's mine. That's my read here, Tyler. What about you? I'll let you go next.
Yeah, I think that's fine. The logic is fine. I don't disagree with any of that. I would just echo what you just said. I do have one question. So, and this is also just a bit of education and insight. So the PE ratio price is a given. That's the current price. We're looking at trailing 12-month earnings, I assume, for
Those
this,
are
Greg?
TTM. Yeah, I confirmed it's
Yeah.
TTM. I looked at my source too. Yeah.
So the little asterisk that goes along with these high numbers is perhaps the last 12 months of earnings haven't been as good because of the recession, and that then is why these look maybe more expensive than they usually are. Is that kind of the idea, Tim? So over the next couple of years, if earnings kind of jump back up to where they usually are, that quickly makes these look less expensive on a valuation basis, right?
That's right. That's right.
Yeah.
Which is why their forward PE ratios are lower than their current PE
Correct.
ratios. Yeah. So you agree with my analysis, Cody? You got a different take? Which one you buy? Which one you hold? Which one you dump?
Slightly different. So looking at each of these, so again, yeah, everything you said, and of course this is a tough decision because they're so close and they're all three great. So name the game though, got to dump one. The one I'd actually be dumping, I'll start with that one, is going to be ETN, excuse me. And the reason why is all the other two charts, as far as current entry now, I like better, whether I have to hold it or trade it. I like the way these charts look better as far as current entry prices. So if I had to dump one, I'm going to have to dump ETN solely on that reason, because I don't necessarily like its chart as well as I like the weekly pullback on ITW, and I like the 200 break on ADP. So I think I would go with the hold of ADP, because I think a 200 break is very significant, and long term, picking up those dividends, they've increased their dividends 45 years. Love that. I think I'm going to trade ITW off that weekly chart. Tyler, can I see the weekly chart on the ITW?
Mm-hmm.
I really like that pullback as far as a trade goes. So from the hold one, I'm going ADP. Trade one, I'm going to go ITW. And the dump, I got to go ETN.
It's fair. It's fair. So you're leaning a little bit on the technicals there to make your decision, and that's part of it.
Because the fundamentals are so close, it's hard to really choose. So it's like, okay, if we like the fundamentals of all of them, the next question I always have is, okay, what price or what area, what chart pattern can I get in and like the price that I'm getting into? Mm-hmm. So that's what I'm basing my decision on.
And, you know, this is my favorite part of this game right now, actually, Greg. Well, no, actually, the analysis that Greg lays out is my favorite part, but then he gets to judge us at the end and tell us what we got wrong a little bit. What do you agree with? What do you disagree with? Right, wrong, or indifferent, Greg? What was your read on this situation?
So yeah, like this is what I love about the game, and love working with you guys for this reason. We all have kind of different ways that we view this, right? You know, one of the things that you said was, you know, you're happy with a company that pays, you know, 7 years in a row of consecutive dividend increases. You know, when I look at that, because I look at it a little differently, and that's why you got old money in my nickname there. Mm-hmm. I look at it and I say, okay, what's happened in the last 7 years that would make me kind of think, okay, you know, a company should have paid increasing dividends for 7 years. When I go looking at one that's paid it for 45 years in a row, and basically every year since it opened the company, I go back and I look at what happened from an economic standpoint, and whether this company was able to continue to do that successfully. So I look at ADP and I go 45 years in a row. We've gone through how many stock market crashes? We've gone through oil prices. We've gone through, you know, pandemics. We've gone through all sorts of different things that could have tripped this company up, and yet it did nothing of the sort. Not only that, their payout ratio being 64%. 64% is a very healthy payout ratio. It's still rewarding your shareholders, but it's not getting yourself into trouble where you couldn't continue to do that, even if there is a downturn. Well, as you can see, their sales growth this year was only 2.4%. What I really like most about that is the fact that, yeah, they're looking, you know, when you start looking at their projections for next year, and I think you always have to take that with a grain of salt, but you start looking at that and you start going, okay, these guys here, they have a good core business, and they fully expect to be back up and clicking, you know, when things are reopening and all that stuff. So I like the stability of ADP, you know, overall the best. I like the fact that it still has, even though it's kind of I would term it as maybe a slower mover, it's still got that growth potential to it. So you kind of get the best of both worlds here. So for that reason, I would actually hold ADP. It's one that I think I could hold and be happy with that. Now, the PE ratio, I wanted to make mention of that. If I took the PE ratio of all the industrial stocks and I couldn't find it, but I'm guessing that the average would not be that much different than that 34. Again, I couldn't find the proper number just in the time that I looked for it. But I don't think that 34 would be all that different than if you looked at, I had a list, I think, of about 15 companies I looked through, and they're all going to be, I'll just say ballpark, right? You're not, as you said, you're not going to find a 10 PE ratio in an industrial stock with numbers like the rest of them. So that one there. Then I start looking at the rest of it here. Again, so ETN and Illinois Tool Works both being very similar in nature. I like the 2% dividend yield for ETN, but that payout ratio, that 84%, that does concern me a little bit. It's not a deal breaker, but it's getting up to that part where if things start to go bad, and, you know, I'm always looking, you know, I'm happy with times when they're good, but I also want to be happy when times are not so good from a company standpoint. So that's kind of how I view this here. So being at 84%, it's not a deal breaker, but it's pushing that echelon where I'd rather it not be that high. So they could have increased their dividend less and their yield a little bit less and had that more in line. The PE ratio, it is considerably higher than the rest. So when you do start looking at as a value play, and I think you can compare, ETN and Illinois Toolworks are more similar businesses than ADP. Like they're all in the industry sector, but they're closer. So when you look at those numbers, I would be dumping ETN just because of that payout ratio and the PE ratio. I think you get better value with Illinois Toolworks. So this is the one that I would be buying. I really like their sales growth this year. They've got a really solid sales growth next year as well. So at the end of the day, ADP is my stalwart. I'm holding on to that one. I'm buying into ITW and letting ETN, dumping ETN. As you guys have all said, and I agree 100%, they're all really good quality companies. The reason I chose the industrial sector this time around is because it's heated up. It's given us opportunities. And then when you start looking at the technical setups, I frankly like each one of those technical setups. You got a couple of breakouts. You've got a retracement into a resistance level, on the one there. So I think there's opportunities both technically and fundamentally. You've got some really good companies here.